Today we're going to be ranking the top 10 stocks to buy in 2026 on a tier list according to the Motley Fool. Let's get into it. So I've been going through some different articles looking at what different companies, what different firms think the top stocks to buy for 2026 are, and I like this one from the Motley Fool. So what I wanted to do was not only review it, but also rank them on a tier list. So I want to go over my criteria and how I'm grading these stocks. So we're going to be looking at these companies two different ways. One, how they actually are as a business. So business quality, growth potential, their moats in general. And then also, are these stocks to buy? So there are going to be a lot of great stocks on this list, but not all the valuations look great. Not all of them look like great buying opportunities. So in this list, we could see a great company be a B or a C tier just purely based on valuation. So I want to kind of get that out of the way before we get into it. Now let's see what the Motley Fool says about the stocks they select. So they say, I like these stocks as long-term investments. Even if a market crash or bear market arrives, I have absolutely no idea what they'll do over the next few weeks or months. In fact, if inflation unexpectedly spikes higher, trade tensions escalate, or the US falls into a deep recession, it's entirely possible that most or all of these could decline soon. They also mentioned that these 10 stocks aren't meant to be a well-rounded portfolio. It's just their highest conviction stocks. So the first stock they have on this list is PayPal. So what they say is PayPal is an absolute cash machine that is down by 80% from its highs. If you aren't familiar with the recent history, PayPal has completely overhauled its management team in late 2023. Every member of its C-suite is new to the business, and it's an impressive group. Something they mentioned is PayPal announced an agreement with OpenAI in late 2025 to become the first digital wallet integrated into ChatGPT. And since new leadership took over, efficiency has improved dramatically and earnings per share is significantly higher. They think this could just be the starting point for PayPal. Management presented investors with a growth roadmap in early 2025, which showed that the team believes it can achieve sustainable 20% annual earnings growth in the not too distant future. They also highlight some numbers, like they have over 434 million active users across PayPal and Venmo, and it processes over 1.9 trillion in annualized payment volume. So just looking at PayPal in general, this is a stock that has completely fallen off over the past 5 years. They're down over 76%, and when we're talking about from highs, they're down over 80%. And in the last year alone, the stock fell over 35%. Now, at the current moment, revenue is not growing fast. It's only growing at 4.5%, and valuation is priced in like that. Valuation is priced in like this is a dying company trading at a trailing 12 months, 11.3 PE ratio, and forward-looking 8.8. I am going to put PayPal in the B tier. Now, their bull case for PayPal is pretty clear. They see a beaten down stock with a fresh new leadership team looking to get things back on track. They are improving efficiency, they have strong cash flow, and the valuation looks incredibly cheap. Now, all of that is true. Where I kind of disagree and see it as a B tier is the assumption that better execution will automatically lead to stronger growth. Now, payments is one of the most competitive spaces in tech. Consumers don't really care about what wallet they use, and merchants have more options than ever. So I see it as even if PayPal runs a better business, that doesn't guarantee it regains pricing power. So I don't think PayPal is broken, but I'm viewing it more as a cash flow stabilization story than a true compounding company. Now, cheap valuation 100% helps, but a cheap valuation doesn't automatically make a company have a greater moat. That's why I'm putting this in B tier. Like I said, they bring up some solid points and some agreements, but there's a lot of execution risk and competition in this field, so I think B is where it deserves to go. Now, their second stock is Airbnb. Few companies have been as successful in disrupting an entire industry as Airbnb. From 2017, this company has since evolved to become a leader in changing the way millions of people view travel accommodations. They have over 5 million hosts who have over 8 million properties and experiences on its platform. And in the third quarter of 2025, more than 133 million nights and experiences were booked on Airbnb's platform, with a total booking value of $22.9 billion, which represents 14% growth year over year. Now, its overall market opportunity is estimated to be in trillions of dollars, encompassing both short-term and long-term stays, as well as experiences. Additionally, management appears to believe that the stock's valuation doesn't accurately reflect the long-term opportunity, given that the company has been buying back shares at a relatively aggressive pace. Now, Airbnb is an $81 billion company, and since last year, they've been just around flat, up only 0.5%. When we backed it up over the past 5 years, they're down over 23. And even over the past 10 years, they're down 8%. Now, this company has loads of cash. They have over $11 billion of cash with zero debt. And like Motley Fool mentioned, they are buying back shares. Now, I believe Airbnb deserves to go in the B with PayPal. Now, I agree with a lot of points Motley Fool says again. On paper, they are a great business. They are extremely asset light, they're highly profitable, and they're still growing bookings. The one hesitation I have is that Airbnb doesn't control their own destiny. What I mean is cities and regulators control the supply more than Airbnb actually does. And those rules can change market by market and constantly. These regulations add a layer of uncertainty that you don't really see with software and cloud companies. Now, while I think Airbnb is a high quality company, it's really more so the structural risks that keep it in a B tier rather than going higher. Now, the third company they have on this list is MercadoLibre. So they say one of my favorite long-term stock investments in the market. MercadoLibre is often referred to as the Amazon of Latin America, and for good reasons. The company operates an e-commerce marketplace with a dominant presence in some of the region's most populous nations, including Brazil and Argentina. However, there's a lot more to the business. It operates a fast-growing payment platform, a logistics service, and a business lending platform, plus a few more. Now, they mentioned the company isn't just the Amazon of Latin America. It's the Amazon, the PayPal, the Block, Shopify, and more all into one. And they still say it's in a much earlier stage of growth. As the e-commerce and fintech landscapes in Latin America evolve over the coming years, MercadoLibre could be a major long-term beneficiary. Now, this is a company that sits at about $100 billion market cap, and last year they grew about 14%, but when we go back over the past 5 years, they're only up about 10%. Now, if you backed it up to the past 10 years, they're up over 2,000%. So just alone, the past 5 years have been rough for this company. Now, I am going to put this company in the A tier. Let me explain why. Now, I think one of the biggest things, and one of the biggest things Motley Fool talks about, is that they aren't just the Amazon of Latin America. It's the Amazon, the PayPal, they're a fintech platform all into one. And what makes us very bullish is how everything is interconnected into one. So e-commerce feeds payments, payments feed lending, and lending feeds back into merchants. This is a flywheel that is very difficult to replicate. Now, the reason this lands in A tier instead of S is slightly due to the valuation, but also geographical risk. A lot has gone right for this business already, and operating in emerging markets adds volatility that you don't get with US mega caps right now. Now, even with that, structurally, this is one of the strongest growth stories on this list. Now, I do agree with Motley Fool here, but the reason I don't put it in S tier and have it in A tier is because I want a little more margin of safety before putting it in that highest tier. That's why it comfortably sits in the A tier for me. Now, their fourth company is CrowdStrike. So it seems like every week there's another high-profile security breach. The need for cybersecurity solutions certainly isn't getting any smaller. And that's especially true when it comes to the cloud-based security. CrowdStrike is leading the charge to keep data secure in the cloud. This is a best-in-breed cybersecurity company with a highly effective platform. CrowdStrike collects security data from its numerous users, analyzes it, and utilizes it to automate security across its entire network. This makes the platform highly effective at detecting the newest threats. So they mentioned with almost $5 billion in annual recurring revenue and an 80% subscription gross margin, CrowdStrike's growth has been impressive, but this could just be the beginning. The company sees its current addressable market at $116 billion in potential revenue and expects that opportunity could be more than double to $250 billion by 2029. So over the past year, CrowdStrike has grown over 28%. Over the past 5 years, it's up about 109%, which is beating out the S&P 500. Their growing revenue is about 22% right now, and over the past 5 years, 43% year over year. And they're another company with a lot of cash and little debt. Now, I think this company deserves to go in A tier. So the main point that the Motley Fool makes is that cybersecurity demand is not slowing down, and they are one of the few companies that actually benefits from every new breach. What stands out to me is the data flywheel. So you have to think, the more customers CrowdStrike has, the more threat data it collects, and that makes a platform better over time. That starts to create real switching costs. Once a company is on Falcon, which is their platform, it is very hard to leave. Now, the reason it is an A tier and not S tier is because the valuation is expensive. There is a lot of future success already priced in, so the margin of error is not huge. But when we're talking about from a pure business quality standpoint, I think this is an incredibly quality company. Cybersecurity demand is going to continue to accelerate, and CrowdStrike is positioned for that. That's why right now valuation is very high, but I think this is one of the companies that deserve a higher valuation. Now, I think this valuation is too high, which is why it's not S tier, and I'm grading this more on the quality of the business than the buying opportunity, but I think they are positioned very well for the future. Because of that, it deserves an A tier. Now, for their fifth company, they have Intuitive Surgical. So robotic assisted surgery beats shaky human hands. The general thesis hasn't changed significantly since I first noted Intuitive Surgical stock in 2005. The Da Vinci surgical system is the clear market leader, and its razor and blades model help the Intuitive generate a reoccurring stream of revenue. In the third quarter of 2025, Intuitive Surgical reported year-over-year revenue growth of 23%, fueled by 20% growth and performed Da Vinci procedures. Intuitive Surgical is a dominant player in its space with a global market share of approximately 80%. This is a company that last year was down about 7%. Over the past 5 years, up 108%, so they did beat the market out over a long term, but right now, they have been a little flat over the past year. We are seeing revenue lately almost reaccelerate. Over the past 5 years, it's grown 17% year over year, but the past year alone, it grew 22%. This is another company with a lot of cash and zero debt, almost $5 billion in cash with zero debt, and they're starting to buy back some shares with the cash they have. So I really struggle to grade this stock. Right now, I'm between an A and a B, but I think I will put it in the B for now. That might change after I explain again and rethink it, but I'll explain why. So the one thing about this business is they have a very strong moat. They have one of the strongest moats in healthcare. So this is a company that has a clear system for robotic surgery, and they also have, like Motley Fool mentioned, a great blades and razor system. So once hospitals have these machines, they're stuck there for years. They're stuck there for years through training, consumables, and service contracts. From a pure business standpoint, this is elite. Where I push back on is something that is a little hard to completely understand is how much of that dominance is already priced in. This company is growing, and we saw revenue slightly reaccelerate this past year, but it's also trading at a high valuation. Now, when we compare that to a CrowdStrike where the valuation is also high, I just think the cybersecurity branch, the cybersecurity industry, that demand is going to skyrocket, I think, over the next 5 to 10 years as technology continues to advance. When we look at hospitals and healthcare, they adapt more slowly, procedures expand slower, and healthcare innovates at a much more controlled and slower pace. So I like the business a lot. I like the moat a lot, but as an investment today, I do think on this list, there are better opportunities. Now, I do think I'd put this over a PayPal and Airbnb, so it's going to be the first place in the B tier, but I think it's right around that edge just because of the industry it operates in. Now, their sixth stock is Shopify. So Shopify operates a platform designed to enable businesses of all sizes to sell their products online with their particular focus on empowering smaller businesses and growing with them by establishing long-term relationships. Shopify offers a subscription plan starting at $39 a month per business, but they do even less if it's just a one-person merchant. Now, the company also provides many adjacent services that help businesses operate smoothly, such as a payment process solution and logistics. Shopify's one-stop shop approach to enabling e-commerce has turned into a powerhouse and now has more e-commerce sales flowing through its ecosystem than any other company besides Amazon, and Shopify could just be getting started. The platform has generated over $11 billion in revenue over the past 4 quarters. However, this is just a fraction of the estimated $153 billion and growing market opportunity as retailers shift their focus to online business. Now, when we look at Shopify, they're a company up over 52% last year. Over the past 5 years, they're actually up only 34%, so a lot of that growth is coming from this past year. To start this year off, they're up about 0.2%. Now, I'm going to start this company off in C tier. Now, Motley Fool's case is pretty straightforward. It is a powerful platform sitting at the center of e-commerce, and especially for the smaller companies, the mid-sized businesses. I agree with all of that. And Shopify is also clearly the second most important or second biggest e-commerce business besides Amazon. Product itself is very good. Where I disagree and where I have worries about it for an investment this year is how Shopify's growth is tied into small business health and consumer demand. So a lot of Shopify's merchants operate on thin margin. Because of this, during slower economic periods, those are the first businesses to truly feel pressure. That makes growth less predictable and more cyclical than the platform narrative suggests. So I think long-term, this is a great company and a long-term winner in the e-commerce space. But at today's valuation, I don't think you're just betting on the growth of e-commerce, but you're also looking at a sustainable continued boom of small businesses online. I think the current market and economy we're in right now is pretty unpredictable, and a company like this trading at a high valuation is a company at higher risk. Now, again, when I'm looking at the business itself, I think this is a strong business, but the investment opportunity isn't something that I would take on right now. Because of that, I'm putting it in the C tier. Now, the 7th company is Disney. This was an interesting one. So they say the House of Mouse is like the all-weather tires of a portfolio. The pandemic hurt its theme park and movie business, but helped the Disney Plus streaming service, which has grown into a powerhouse years earlier than Disney expected. In fact, 6 years after launching, Disney Plus Core has more than 130 million paid subscribers, while Hulu adds tens of millions more. Additionally, the market is absorbing price increases with minimal impact on subscriber counts, and Disney's streaming business is now profitable. Now, while consumers are clearly feeling the pressure of inflation, demand for Disney's theme parks, movies, and cruise line has been strong. In fact, per guest revenue in Disney's parks is far greater than in comparison to pre-COVID times, thanks to initiatives that have driven higher in-park spending. Additionally, the company is investing $60 billion over the span of a decade in the theme parks and cruise line to ensure they remain full for the foreseeable future. Over the past year, Disney is up 6%, but over the past 5 years, they're down 34%. And if we're going back over the past 10 years, they're up only 20%. So this stock has been pretty flat over the past 10 years. It's been a poor investment, significantly outperformed by many stocks in a time when the stock market has done great. Revenue right now is growing 3% year over year. Over the past 5 years, it's only grown 7%. Over the past 2 years, 3%. And we do have revenue per subscriber growing slightly, up about 4.3% year over year. Over the past 5 years, about 6%, actually about 7% year over year. But this is a company I'm gonna be adding into the C tier with Shopify. Now, some of Motley Fool's cases for Disney do make sense on a surface level. Disney owns some of the best intellectual properties on the planet. The theme parks are starting to hit again after COVID, and Disney Plus is finally crossing into profitability, and they're competing in a highly competitive streaming industry. Now, from a purely asset standpoint, Disney is a very strong company. Where I push back is execution risk. Disney has incredible businesses, but they're spread across a lot of different segments. They have streaming, they have parks, they have movies, ESPN, cruises. Each one of these is capital intensive and managed very differently. Now, I just think that makes consistent, predictable growth harder than it looks on paper. Now, the parks are cash machines. There is no question about that, but the parks also require heavy reinvestments. Streaming is also improving, but this is also a highly competitive space with thin margins. The studio side of the business is very hit driven based on whether a movie hits or not. That's gonna add even more volatility. Now, while Disney is considered a safer business than most companies, I just think the upside is purely capped. So I don't necessarily dislike Disney. I do think it's probably the safest business on this list, but safety alone isn't going to have it higher on this tier list. For that reason, I'm putting it in the C tier. Now, their eighth company is Berkshire Hathaway. Although most of this list is made up of growth stocks, or at least stocks that have some exciting growth drivers, this is the relatively boring value pick of the bunch, but in the best possible way. Now, Berkshire Hathaway owns a collection of about 60 subsidiary businesses, including household names such as Geico, Duracell, and Dairy Queen, just to name a few of them. Berkshire also owns a portfolio of common stocks worth about $315 billion as of December of 2025. That includes some massive stakes in Apple, Bank of America, Chevron, American Express, and Coca-Cola, as well as positions in dozens of other companies. Now, Berkshire has continued to produce market-beating returns in most years despite its massive size. And while Berkshire certainly won't produce the roughly 20% annualized return it has produced from the time Buffett took over the helm in 1964 through the end of 2025, there is no reason to believe it won't continue to outpace the S&P 500 index for the foreseeable future. Now, in fact, the company has also reached an impressive milestone by becoming the first non-technology company to reach $1 trillion market cap. Buffett recently stepped down as CEO, but the company is in good hands. Berkshire's winning culture is likely to live on for decades, even in the post-Buffett era. Berkshire last year grew at about 6% pace. I think a lot of this has to do with the news of Warren Buffett stepping down that scared people. But over the past 5 years, this company has done just fine, up 109%, which has beaten the S&P 500. And over the past 10 years, they're up over 284%. Now, I'm going to put this company in A tier. So the Motley Fool labels this as the boring pick of the bunch, and I think that's exactly why it works and why I'm putting it in the A tier. Berkshire isn't about the flashy growth. It's more so about owning a collection of incredibly durable companies and letting them compound and do the work. Not only do they have the wholly owned businesses, but they also have a massive portfolio of equity, and they have an enormous cash position that gives them so much optionality and flexibility that no other company has. Now, I think the best thing about Berkshire is the just capital allocation. Now, like I mentioned, even in the post-Buffett era of Berkshire, they have over $300 billion of cash. Some might view this as dead money, which I don't think that is at all. I think it just gives them an incredible amount of optionality. Whenever the market breaks or there's incredible opportunities out there, they are going to execute and have the capital to do that better than pretty much every single company in the world. Now, the reason it's not an S tier and it's an A tier, I think is purely just because of upside. The Motley Fool mentioned that it is unlikely that Berkshire is going to grow at that 20% pace it has over the past 60 years now or 70 years with Buffett, but it should be viewed more as a sleep well stock at night, a stock that you could count on beating the market or having just about market returns and you don't really have to worry about the company. I think the consistency and downside protection is really what makes Berkshire a very solid investment right now in my opinion, and that's why it is going to remain in the A tier for me. Now their ninth stock is one of my favorites, and it's Amazon. So they say Amazon doesn't really need much of an elevator pitch for most people. The company maintains a dominant market share in the US e-commerce market, and as Amazon Web Services, so AWS cloud platform, is also a market leader with significant lead over the other two large players in the space, which are Microsoft and Alphabet. However, more growth potential exists than you might think. We're still a long way away from maximizing e-commerce adoption, as it accounts for only a little more than 16% of all US retail sales. The cloud industry is relatively young and expected to quadruple in size to a $2.3 trillion market by 2032. And Amazon has a ton of potential in other areas such as healthcare, grocery stores, neighborhood markets, and more. Now, if you've watched me before, I don't talk about Amazon too much, but this is one of my most bullish stocks I own. When you look over the past year, this stock has been very disappointing. When you look at other tech stocks like Microsoft, Nvidia, Google, it has heavily underperformed. They're up only 7% over the past year, and over the past 5 years, up 52%. So while all these other stocks, all these other opportunities are way outpacing them, Amazon has lagged behind. Now, I do not think this is here to stay. I think Amazon is going to be an incredible investment in the future, and I am putting it in the S tier. Amazon is a massive company, a dominant company. They dominate e-commerce, they dominate AWS, cloud computing, and they just have so much future potential and opportunity coming up. The reason it is S tier for me is the way all the different parts of the business compound together. AWS alone would be a phenomenal business. It is basically the backbone of the entire internet, deeply embedded into different enterprises, and it is perfectly positioned to benefit from the AI boom. On top of that, obviously Amazon's retail business is dominant. They're becoming more and more profitable through logistics, optimization, and advertising. And the notion that Amazon is a low margin retail business is just a far outdated connotation. This is a company that is going to heavily benefit from AI and robotics, and a company I think could win the robotics race. This company I think is going to be the next big tech company to dominate, and that's why I have it in the S tier. Now the last stock we have is Alphabet. So Alphabet isn't exactly a household name, but its main subsidiary, Google, certainly is. And there's a lot more to the business and its potential than the massive internet search operation that has a dominant market share. Google is divided into two main segments. They have Google Services and Google Cloud. Google Services include YouTube, Google Play, Gmail, Android, Chrome, and the Nest smart home products. This part of the business makes most of its money from advertising, but there's also significant revenue from hardware and in-app purchases. Google Cloud is a company's cloud service division, holding the number 3 market share behind AWS and Microsoft. It has been growing its market share in recent years, and the cloud infrastructure market itself is forecasted to quadruple by 2030. So while this accounts for approximately 10% of the company's revenue today, it could be the biggest growth driver for years to come. Additionally, Alphabet has a segment called Other Bets, which owns several promising early-stage businesses. The self-driving vehicle technology company Waymo is perhaps the most notable and has a clear market lead in the young robotaxi industry. While none of the other bet companies produce any significant revenue net, there is a lot of long-term potential. Over the past year, Google is up over 71%. This is a stock I owned last year when I was buying during these dips, and it has done great for me. Over the past 5 years, they're up 271%. So Google has been a phenomenal investment. They have also recently become the second largest company in the world, and they have over a $4 trillion market cap. Now for me, I'm going to put Google in A tier. Now I think Google is an incredible company. They just have so many different parts of their business. They're so diversified. They have Google Search, YouTube, Android, Chrome. They also have Google Cloud. And these are some of the most dominant digital platforms ever. You have to ask why, if I'm so bullish on Google, is it an A tier and an S tier? A lot of that mainly comes from just valuation. And then there is some uncertainty with Google and the core business model long term. Now, Google is still heavily dependent on advertising. Now, while that has been great for the business, it is also part of the company that is facing the most disruption from AI. Now, search is not broken, advertising is not broken, but it's just a part of the business that has to continue to innovate. Now that's more the risk I see in Google. It's not that AI is taking over the business like that was a narrative back in April, May, and June. They have totally showed that's not the case, but they are in a competitive space. They will have to continue to innovate with AI, and that just comes with a little more risk. I mean, they do have incredible optionality with AI, cloud, YouTube, search, just everything going on in the business. And as a business has continued to grow, valuation is on the rise, so that's always something to keep out for. That's why I have it in A tier instead of S tier, but I think this is a phenomenal business. So that's going to be it for today. Here is my tier list going over Motley Fool's top 10 stocks to buy in 2026. If you like this solid video and want to see more tier list videos, or you just have stocks you want me to go over, let me know. Now again, this is all in my opinion. If you want me to go deeper on any of these stocks and have a real breakdown, let me know, but that's gonna be it. Now this is not financial advice. I'm not a licensed financial advisor. This is just for educational purposes only. You should always do your own research before buying a stock, and I appreciate your support, and I'll see you in the next one.